What are the risks and opportunities for NBCUniversal in the Peacock-YouTube Premium bundle launching in 2027, and why we believe the Paramount-WBD Discovery deal will likely collapse? Listen on.
Welcome to this week's edition of Inside the Stream. This is Will Richmond from Video News, and of course that was Colin Dixon from N-Screen Media at the top there. Colin, World Cup is behind us, but still plenty of excitement and drama in our world to follow, right?
There certainly is. We've had a couple of bombshells in the last week we're going to talk about today, and I think we're going to get started with the YouTube Peacock announcement, which I think caught both of us off guard, right?
Yeah, I mean, well, go ahead. You're going to explain it, and then we'll talk about why it seems somewhat surprising to us. So, well, last year, Peacock became available through YouTube's Premium Channels deal. And so that meant basically if you're a YouTube user, you could subscribe to Peacock from within YouTube. And in fact, I think they added the ad-free, they just recently added the ad-free tier as well. So you can subscribe to both tiers of Peacock within YouTube. Well, they have really expanded their relationship dramatically, and this will all take place in 2027, because in early 2027, Peacock Premium, which is the ad tier, will become available to everybody, I guess in the US, who has a YouTube Premium subscription. So if you currently have YouTube Premium, starting on that date, you will be able to watch everything that is currently in Peacock Premium through YouTube. So you won't have to leave anywhere. You can find all the sports, all the shows. They'll all be right there. So that means you can watch NFL, Olympics, NBA, MLB, Notre Dame football, and a whole bunch of shows like Saturday Night Live, Law and Order SVU, etc., etc. Plus all the movies that Universal produces, all with ads, which is a bit confusing when you think about it, because one of the reasons you subscribe to YouTube Premium is so that you can skip the ads. You don't have to watch any ads, but apparently you will be watching ads inside of this content when you're watching it through your YouTube Premium subscription. And this is a multi-year distribution deal, so there's that part. The companies will also be deepening their long-standing advertising technology collaboration. They've been working together there. And this is through NBCU's Freewheel. They bought Freewheel 6 or 7 years ago now. That's their big advertising technology platform. And in Europe and some other markets, this deal was actually also involve Universal Plus and Hey!, is certainly available in UK and maybe in other markets. Hey! Provides a lot of the reality TV properties that are NBCU to those markets, so Kardashians, etc. NBC Sports will be the production partner for selected premier live sporting events on YouTube as part of this as well. And they also say they're going to make a selection of live sporting events that would have been available in Peacock Premium. They're going to actually make these available to everybody through YouTube. So they're going to use this as a way of promoting the fact that NFL, NBA, Premier League, etc., is available in this deal, but also inside of Peacock if you want to subscribe that way. So it's a pretty wide, pretty expansive deal, Will. And it has got us both wondering how much cannibalization this will cause, because I know from my perspective, I'm actually a Peacock Premium Plus subscriber, so I'm watching ad-free. But it turns out that a great deal of my viewing inside of Peacock is still with ads. Actually, the only part of my viewing that is without ads is for the dramas and for the TV shows and movies, of which there's,
one or two or maybe three shows inside of Peacock that I like to watch, that my partner and I like to watch. So it's got me wondering if maybe I should just cancel and I should just start watching for free. And if you have Peacock Premium and you're watching ads anyway, and you are a YouTube Premium subscriber, this has got to be, you've just got to cancel your Peacock Premium subscription, because you can watch all of that content for free inside of YouTube. So That's the shape of the deal. I'll pause for a second here.
Right. And we know from, and just to clarify one thing, what you were saying is that you watch a lot of ads already in Peacock Premium because your consumption is skewed to sports on Peacock Premium. And sports, of course, comes with ads. So a piece here, we got data from our friends at Antenna. They said that as things are, believe that 19% of YouTube Premium subscribers also take Peacock. And that's several percentage points below anybody else. For as an example, 24% of Paramount Plus subscribers take Peacock. The only one with less is actually Netflix. 18% of Netflix subscribers also subscribe to Peacock. So, to sort of bound what that cannibalization might look like, we're talking about 19% of YouTube Premium, current YouTube Premium with Peacock. How many of those people are going to do what you just said and drop their Peacock and fold into, you raise a good point that we don't know what percentage of the YouTube Premium plus Peacock subscribers, what percentage of those Peacock subscribers are taking the Premium Plus ad-free version of Peacock versus those taking the Premium. Terminology, of course, is very confusing here, but Premium is actually with ads. So, but your point is well taken. There's going to be some piece of cannibalization. So we want to just spend a few minutes here just talking about, how do we think this deal works and why does it work? Why does Peacock believe it works for them? So risk number one, as you point out here, is there's going to be some cannibalization. There are going to be some number of people who currently pay Peacock $11 a month. They're going to drop their $11 per month subscription and fold in under their YouTube Premium subscription. So there's some risk of cannibalization. On the flip side, as you pointed out, there's a little bit of a disjoint here that Peacock Premium subscribers partially do that to free themselves of watching ads on YouTube, are now going to be getting ads on Peacock Premium. So not clear exactly, how that's going to play for YouTube Premium subscribers, but it feels like, as we were talking about this earlier, that part of the deal here is that Peacock is going to give up this revenue and probably keep 100% or close to 100% of the ad revenue that they generate within Peacock ad inventory. They're going to keep most of that revenue. But they have to make up for the cannibalization that's occurring, obviously. And we're sort of speculating that part of the way that they'll make up on that cannibalization is that they're going to get some kind of a fee from YouTube. And we're sort of back and forth, and you can explain this better than me, but are they going to get a bounty for each new subscriber, YouTube Premium subscriber that gets brought in? Are they going to get a monthly fee from YouTube based on viewership of Peacock? How do you sort that out, do you think?
Yeah, it's a difficult one. And obviously, you and I, we have no details. No details have been announced about exactly how the money will flow. We don't even know that Peacock, we're speculating that NBCU will keep most, if not all, of the advertising revenue that's shown within the NBCU content that's part of this deal on YouTube. We're speculating that because, well, it's kind of easy for that sum to work because the people on YouTube Premium aren't watching ads. So we think that that's highly likely. The way the fee would potentially work is a sort of sliding scale will. I think they're probably watching how much NBCU content people are watching as part of this deal. They'll be able to count that. And remember, this is an organization that is supremely qualified to to track that information. They're already tracking all of this type of stuff for the creators that they support. And they'll have some sort of sliding scale fee, which they pay NBCU each month for people who are watching the content. People that watch very little of it, they'll get very little money for. People that watch a lot of it, they'll get a lot of money for. So, I say a lot. we were bouncing some numbers around. $5 sounds like a lot, maybe too much, but maybe $2 or $3 for those folks. So they may not lose the whole potential fee. But anyway, whatever way you cut it, it feels like this is a risky move. If they do see a lot of cannibalization, and my suspicion is they will, because people are really smart when it comes to money, a good proportion of those people that are currently subscribing to both services will cancel. It's even got me thinking about doing that, as I said, because, is a few shows watched without ads worth the, $16 a month I'm paying to be ad free? And probably the answer is no, they're not.
Right. So we know that it's going to be all over Reddit, that, it's a no-brainer if you're in a situation like you're in, to fold into the YouTube Premium. It also strikes me, and again, we don't know we have a sense here of what the risk factor is in terms of cannibalization. We don't know what the compensation is going to be from YouTube to Peacock to now be a part of this, but I don't think it takes a lot to speculate that each new Peacock subscriber gained through the YouTube bundle is going to be less profitable for Peacock than standalone Peacock subscribers are. I'm just going to put that stake in the ground. No guarantees, but I think that's a fair assumption. In the meantime, we've now spent years with Wall Street insisting to streaming services that they wanted profitability over subscriber growth. Whereas here we seem to have a situation where Peacock is trading profitability for subscriber growth.
Yep.
And we know that NBCU is splitting off from Comcast coming up. So I just find myself wondering, when any one of these M&A deals happens, there's always a bit of window dressing that occurs. Yeah. And, this conversation, I just wonder, how much of this is window dressing, the ability for Peacock to tout that they gained, pick a number, 3.5 million subscribers last quarter instead of 2 million subscribers in the year earlier quarter, even though the profitability on those individual incremental subscribers is kind of
Yeah, I think you're right. And I think it's, they're obviously rolling the dice here. They know that they have spent a lot of money on sports recently. NBA is one prime example. They raised the price ostensibly to offset the cost of that stuff. So they're betting that they'll pick up a lot of incremental viewers to those NBA games by doing this. Because if it's available for free as part of your YouTube Premium subscription, there is zero barrier for you to watch that game, whereas you're quite unlikely to subscribe just for one game, right? So they could quite likely pick up a lot of viewers to games that are offered. And I don't know, will it be enough? You and I are kind of skeptical that it will be enough, particularly when you hear Netflix saying things like, well, we're currently not able to make up the difference between our ad-supported and our non-ad-supported. We're not making that up. Will they be able to do it? I don't know, but we're both skeptical that it can. But anyway, perhaps that's enough on that deal. We should talk about the other big bombshell in the last week or so.
Well, a far bigger bombshell on the spectrum of bombshell degrees was late last week. Paramount and Warner Brothers agreeing to delay the closing of their deal until either, and essentially agree to taking the deal to trial following the judge's temporary restraining order on the deal closing in response to the states and the Writers Guild suits to stop the closing. So they agreed that they would hold off on closing the deal until 5 days after a trial concludes, or June 1st, 2027, which again that's almost a year from now. So they went from looking to close the deal kind of the day after tomorrow, which is what was playing out last week, to then being willing to delay it by up to a year. And so again, we're in the realm of speculation here, but I'm going to explain in the next few moments why I think, given this delay, I think there's probably no better than a 25 to 30% chance that this deal actually closes eventually. And there's three key points that are very much interrelated. The first and most important is that the delay is going to reveal the declining value of Warner Brothers Discovery, and therefore that it's, even if the antitrust trial goes for Paramount, that it's really the value is no longer there at $110 billion. The second reason is that there are elements to the way the deal's economics are structured that favor Paramount, in particular Larry Ellison, which is a lot of what this conversation is going to revolve around, Larry Ellison deciding to back out of the deal. And the third thing is that related to, again, Larry Ellison and the dynamic that's going on with Oracle stock and AI in particular. So let me leave it at that for the moment and just drill down on each one in particular. So in terms of the value of Warner Brothers Discovery, we need to remember, of course, that Paramount really wanted this deal, and they sweetened the deal like 4 or 5 times, even while Netflix was standing pat. And then Netflix eventually backed out. And they won the deal for, $111 billion. Important to note that Netflix stock is down 40% in the past year, 20% year to date, slightly down since it's backed out of the deal. Netflix, as we talked about a couple of weeks ago, it reported Q2. Of course, there are a lot of engagement questions surrounding Netflix, but they still grew revenue about 12% in Q2. I mean, it's still a healthy, growing business. Conversely, Warner Brothers Discovery revenue is still heavily dependent on TV. I think something like half their revenue comes from something TV related, and I think even a greater percentage of profit comes from TV related. So these are obviously declining businesses, and that shows up in the numbers. If you look at Warner Brothers Discovery, revenue and annual and quarterly revenue and profitability over the last couple of years, steadily trending down. Sometimes it's slightly flat, but generally it's trending down. So in that context, question to you, Colin, is there any reason to believe, that by the time this deal potentially clears an antitrust trial, which may not be until April or May of next year, is there any question that Warner Brothers Discovery is going to be worth less at that point than it was worth in February of 2026 when the deal was announced?
Yeah, I think in my mind, there's no question at all that it will be worth less. I mean, I was looking at their numbers, Will, and as you say, television revenue still occupies a very, very large proportion, about 50%. They earned $4.4 billion in the quarter just ended, in the first quarter, of 2026, and the company overall earned $8.9 billion. TV revenue was down 8-9% year over year, and so assuming that happens again, that means is that you're going to see another 500 million wiped off the books there on a quarterly basis, another billion gone. Even at the level, even though they were able to maintain the overall revenue of the company pretty much unchanged, it was down about 1%. They said they made a huge loss. They made a $3 billion loss. Some of that they attributed, of course, to costs involved with the deal.
Right. That's the Netflix $2.8 billion, just to be clear about that one. Yeah.
Well, actually, they said it was a little bit less than that fell in this quarter. So that it still leaves you with about $1 billion loss on the quarter, X that money that they had to pay to Netflix.
Yeah.
So this is a business that's losing money, and you can bet it's not going to make much of a turnaround. As you said, they're going to be pretty much frozen while this deal is wrestled with over the next year. Yes, this company is going to decline in value. So without question, I think this deal will get renegotiated if the parties continue with it?
Well, okay, let's get back to renegotiation. That's yet a whole other twist. But let me just get into the second related reason that I mentioned here at the top, which is that this deal has these very particular economics, which is first and foremost the so-called ticking fee, which illustrates how badly Paramount wanted this deal, that they agreed that they would pay for every day, every quarter that followed the target closing date, which was last week. They'd pay $650 million per quarter. Paramount would pay to Warner Brothers roughly closer to $7 million per day. $7 million per day that this deal closing was delayed. So the full ticking fee, if it goes all the way to June, would add another $1.7 billion to this deal. And that would presumably all be debt that would be loaded on top of the $80 billion that this combined company would have. The $80 billion consists of $30 billion of existing Warner debt, $10 billion of existing Paramount debt, and $40 billion of new debt that they're putting on the company to fund the buyout. So then we get to this other element, which is that there's a breakup fee. If for any reason Paramount walks away from the deal, then Paramount owes $7 billion to Warner Brothers, and Larry Ellison is actually on the hook for reimbursing Paramount for that breakup fee. So Larry Ellison has to reimburse $7 billion to Paramount, and the $2.8 billion breakup fee that Paramount already paid to Netflix, Larry Ellison has to reimburse Paramount for that. So if the deal breaks up, he's basically on the hook for $9.8 billion. The states, of course, have every incentive to drag this deal out as long as possible because of the ticking fee. So here we are then. We're talking about how this situation plays out. It's actually not just Larry Ellison who's in the driver's seat on this, because there are also banks that have agreed to provide the debt, the $40 billion of debt. And they, of course, have a say. Now, to the extent that the company is less creditworthy because its fundamentals have declined, as we just talked about, they're going to be charging higher rates of interest. In addition to that, we're already in a higher interest rate environment because of this whole inflation thing that's going on. And that's due to the, lots of other costs, but primarily what's happening with the war in Iran. The war in Iran, interestingly, also impacts the equity contributors to this deal, because the Ellisons wrangled $24 billion out of some Middle Eastern sovereign wealth funds. But those countries, their oil revenue, is now impacted by the whole thing that's going on with Strait of Hormuz and the Iran war. So they face now more uncertainty. And by the way, they were in totally the backseat on this deal. No voting rights, no nothing that they were getting out of their $24 billion contribution. And just to do a gut check on whether these sovereign wealth funds do indeed change their mind periodically on investments, look no further than the Live Golf Tour, which Saudi Arabia's sovereign wealth fund funded and has now essentially pulled the plug on because circumstances changed. This would not be unprecedented. So we've got those deal economics. So I'll stop there for a moment to ask you to comment on that as well. Then I'll get to the third piece.
Yeah. So the money side, to me, bearing in mind the value that we see in WBD itself and the amount of debt and the accumulating cost of the deal over the next year, I think it becomes incredibly expensive. And as you say, I think there's every incentive now for Ellison to go, you know what? Well, I don't think this is such a good idea.
Well, don't steal the thunder, because that's
Go ahead with
piece
your
number three here, the Ellison family psychodrama. So Oracle stock was $300 last September. It's now down to around $125. It actually bounced to $250 back in June, but has already come back to about $125. It's down 70% year to date. it was around $200 a share back in January. So Oracle got itself sideways with the market back in September of 25 when it did this $300 billion circular deal with OpenAI, this massive CapEx commitment that it made. And that got even further complicated when the market realized or got concerned that all these SaaS companies like Oracle were potentially at risk with the rise of AI, the disruptive rise of AI. So Larry Ellison's net worth has actually declined. And of course, we're not shedding tears for him, but his net worth has declined now to around $200 billion. So let's just do a quick comparison. Back when his net worth was $400 billion, when Oracle stock was flying high, his net worth was $400 billion, and he was on the hook for $20 billion of equity to fund the Warner Brothers deal. That represented 5% of his net worth. Now his net worth is probably no more than $200 billion. It might even be less than that. If the Middle Eastern investors were to back out because he's agreed to backstop the equity, he'd now be on the hook for $40 billion, the full equity slice. $40 billion on a $200 billion net worth is now 20 to 25% of his net worth, or roughly 4 times his share of net worth than it was back when he was worth a whole lot more. And of course, this is part of why Oracle stock continues to drop, because shareholders are very concerned that Larry Ellison might have to really pony up a lot of his shares. You know, he probably wouldn't sell them, he'd probably borrow against them, but regardless, it puts downward pressure. So it's like a downward spiral for Oracle stock and for Larry Ellison's net worth. So all of that, kind of coupled with everything else that we've already talked about, really starts to beg this question: is this deal really worth it to Larry Ellison? I mean, does he really want to put 20 to 25% of his net worth on a company with declining fundamentals that's going to be even more expensive than it originally was? Or does he say, you know what, I can get out now by simply paying the $7 billion breakup fee, reimbursing the company for the $2.8 billion fee that they paid to Netflix, and I can essentially wash my hands of this whole thing for $10 billion. Now, it's certainly a loss of face, no question about it. Certainly, we don't know, again, what the Ellison family psychodrama is and what that does to Larry and David's relationship with one another. Although you could certainly imagine Larry Ellison saying to David Ellison, look, rather than get embroiled with this morass, what increasingly looks like a highly expensive morass, I'd rather just transfer you 25% of my Oracle shares right now, and let's merrily move on to the next thing. So we've got this question now. Larry Ellison, what's in the head of Larry Ellison as this thing gets more expensive and looks worse and worse?
Yeah. Well, you've convinced me, Will. You convinced me that the right thing for him to do is to back out. I will just make a note before we finish here that we both read this very interesting piece by Natalie Koach in Status. And she talked to a bunch of lawyers about this deal, you know, bearing in mind that they put it on hold for a year. I think the lawyers were pretty much unanimous in saying that this, well, not quite unanimous, but they were basically saying, yeah, this is a big climb down by Paramount Global because they've been pushing to get it done as quickly as possible. And now they're basically throwing their hands up and saying they're going to wait a year. But one of these guys, a guy called John Newman, who's Herf Chair of Excellence at the University of Memphis School of Law, he had this to say. He said, if the companies were smart, they would probably just walk away from this deal. But on Paramount's side, I don't see a lot of smart, rational behavior. So who knows? Paramount may stick it out until the bitter end.
Certainly a company that bids against itself 4 or 5 times is not showing a lot of rationality.
Amen. Yeah, exactly.
But and of course, the irony here, as we talked about last week, is that the state's antitrust case is actually probably not that strong. I mean, who knows? We're not antitrust lawyers, but you know, it may be that the states are actually doing Larry Ellison a huge favor by opening up this time window for him to reassess whether this deal is worth going forward. Okay, let's just assume for a moment, just as we wrap up here, for a moment, the deal does collapse. Now we have Paramount floating in the air here, worth about $8 billion with $10 billion of debt. We have NBCU getting split off from Comcast, and we still have Netflix floating somewhere in the picture here. What do you think in terms of how these pieces get reorganized? Might Netflix swoop in with a new Warner Brothers offer? Might they swoop in with a little lowball offer for Paramount? Might Amazon swoop in for something? I mean, so many possibilities, right?
There are. And I think for sure, nobody is going to offer $110 billion for Warner Brothers Discovery if this deal falls apart. Nobody. Nowhere near. I don't even think Netflix would consider putting up $80 billion, which is where they got to before. I think they probably have plenty of time to think about this, and looking at the numbers, they're thinking, well, maybe this is not such a great idea after all. So I think they would probably be very circumspect. But then again, Warner Brothers Discovery simply wouldn't be worth that much, right? So yeah, I think Netflix is probably sitting on the sidelines. I think a lot of companies are sitting on the sidelines, rubbing their hands at the prospects of this deal falling apart. I think it's highly likely that Paramount Global would get bought as well. Paramount Global needed this extra content, I think, to become more competitive in the general marketplace for streaming, which is where they have opted to play. And they really did need this additional content to continue to expand in the streaming market. And similarly for Warner Brothers Discovery, this debt-laden company needs a reset. It's not been managed well for the last 5 years. There are some very valuable assets here, and I have no doubt that something like HBO will remain valuable in the marketplace, and somebody will be interested in picking that up, but not at $110 billion, nowhere near.
Right, and just to clarify, they're still making money, Warner Brothers. They're not a loss-making company. It's just a company that's been under pressure. They've had declining revenue and profitability now for quite some time because these traditional businesses, TV businesses that they're in, we all know fundamentally are declining. There's no two ways about it. These are declining assets.
Yep, 8 to 10% a year.
Yeah. So, to be continued, as they say.
To be continued indeed.
All right, Colin, good chatting. Thanks, everyone, for listening. We'll see you next week.
Inside the Stream is a production of In-Screen Media and Video News. All rights reserved.